This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the unexpected just happened. And I want you to see why this has serious implications, not just for the global economy, but for the U.S. economy as well. Because we know what happens in other parts of the world eventually makes its way here. And despite all of this, we continue to hear from politicians, policymakers, and other experts. They've been saying that this can't happen. We've told you on this show, we've predicted this move was coming. We've showed you the data. It's here, and it's here now. Now, if you're wondering what we're doing in Beijing at a food stall tonight, well, it's not just because we wanted a late night snack. And I did. It's because this is the epicenter of where things are now have changed for the worse, as you're about to see. Plus, we have a sponsor for today's show who's transforming waste into a 21st century resource. And something else we think they're going to transform is their stock price up by about 16%. We're going to show you exactly how to trade this. Stay tuned to the end of the show for more information, or check out the description or pinned comment. Now let's head over to Bloomberg, where we picked today's story up. As we see, oil executives are surprisingly optimistic on Chinese demand. Now, why are we talking about oil here? Because it's really important to understand that what we're seeing is a move higher in oil based on the idea that we're going to experience not just a global soft landing, but one in China. And we've continued to make the case where things in China are far worse than anyone wants to actually believe. And so what you're seeing here is some idea that perhaps Beijing is going to step in, and we have no information to show this at current time, but we can predict Beijing will, and this is going to cause a big push of consumption in the fourth quarter, which would then cause the demand for oil to rise, and that leads speculators want to get in front of this, but perhaps what they're getting in front of is the wrong thing, as you're about to see. There's a lot of good about what's going on in China here. We see from Ben Looklock, the co-head of trading at Trafigura Group. He told hundreds of attendees at a recent conference, in terms of China demand, the property market is bad, but the other parts of the economy aren't. But maybe they're not so good as he thinks. And that's kind of the whole point of what I'm trying to make today's show, as we get into what has actually changed that nobody said would happen. Well, it did. And this is not a good sign for what's going on in China, or, as you'll see, the rest of the world. As China's crude oil imports were a relatively bright spot in the first half, and demand growth is expected to account for 40% of the global total this year. Jet fuel consumption could rise by a whopping 90% in the second half of the year, according to Sinopec. Beijing is also issuing larger than normal fuel export quotas to help juice growth. So kind of what's going on here is you see in China, they were under this COVID zero policy. People were locked down for a very long time. They're getting out now, and they're doing some traveling. So there's some demand here. But the idea, as we know, the relationship crude oil actually tells us frequently that the broad economy is getting better. Well, what I think here is just a small part of the Chinese economy is better, but the market is really enthusiastic for something I don't think will last. There will be a surge in consumption in the fourth quarter, but signs of that actually aren't being validated by anyone. This from the chief executive at Black Gold Investors. Domestic refinery run rates are likely to remain high, which will boost the country's crude oil imports, he said. The optimism on oil shows how pockets of China's economy are holding up despite the overall slowdown in growth. And there you start to see it. We're seeing a broad slowdown, but we're seeing a pocket here of growth where people want to go out and travel. And we can't blame them. We went through the same thing here in the U.S. All of a sudden, once everybody was allowed to go out, then what did you see? People started traveling, but they didn't necessarily spend money in other parts of the economy. And that's exactly what we're seeing in China. But of course, everybody always thinks it's different. They think that this small pocket is going to turn into a broad-based expansion of consumption. And we're saying, no way. The price of steelmaking staple iron ore, for example, has performed relatively well despite a parade of negative headlines on the property sector. Even gasoline sales, which would make sense as people want to travel, have been absolutely astonishing during the summer in China. People are driving like crazy. And of course, the year-on-year comparisons are going to be dramatic. But it's not just what they spend on gasoline that matters, it's what they spend on everything else. But what it came out also today that's driving crude oil prices higher, well, check this out. As oil surged to new 2023 high after Saudis and Russia shocked with expanded production cut. Now, I want you to understand that this is bad news, not just for the global economy, but for the U.S. economy as well. Because normally, again, as we talk about, as oil prices rise, it tells you an economy is expanding. But what happens if oil prices are rising based on speculation or forced production cuts? Well, that has a big problem for the rest of the world, because what are central bankers gripped with right now? Inflation. So they continue to raise rates, invert yield curves, and cause money growth to slow down. Meanwhile, everyone else is speculating on this, saying, look, oil prices have got to go up. And then you get down to the consumer level, who's still dealing with inflation. We're seeing wage growth slow. We're seeing hours of work get trimmed. We're starting to see a little bit of layoffs start to percolate up, particularly at the corporate level. And what does higher oil prices lead to? Well, you got it. Higher gasoline prices affects the everyday consumer at a time they don't have excess money to spend on this. And just after 9 a.m. today, Saudi Arabia said it would extend the voluntary cut of 1 million barrels per day for another 3 months from October till the end of December, well beyond the expectation of just one more month. And joining in with that, we see Russian Deputy PM Novak said that Russia would not only extend its reduction in oil exports until the end of the year, but also add another 300,000 barrels per day in voluntary oil cuts until December 2023. And this comes back to because both economies need oil prices to go higher. Russia needs it, Saudi Arabia needs it, because everybody's dealing with inflation and debt, and they need to get the price up. So there's only one way to do it when demand is falling. The problem here with America, if gasoline prices go up, it eats a bigger part, of course, of the discretionary spending budget, which we already know for many Americans starting in October is going to get slashed when they get, of course, those payments restart on their student loans, not to mention the lagged effects of the Fed rate hikes on credit card interest rates is going to cause minimum payments to go up. This is not a good thing because growing economies need cheap oil, and this is the wrong move at the wrong time. But something that would be the right move is our CTA-Timer Pro caught this move on the, what you'll see on our Friday report is a quick 3.5% move to the upside and could be a lot more. Now, if you're a subscriber here and you've been watching crude oil looking for an entry point, there you had it on August 31st. The machines started back buying up. If you're watching the price, looking for a confirmation signal, you had it on the machines. Check this out. Just a matter of days later, on September 4th, they went max long, and that means, of course, we've seen this happen before. We know that price is likely to go up. Again, you can check all this out in the description below. The CTA-Timer Pro is a mere $30 a month, and this is what's causing problems now for central bankers, because what we can see is we know when crude oil price goes up, it causes gas prices to go up, and that means the nice relationship between consumer price index has got everybody worried now that this new increase in gas prices here shown on a year-over-year rate of change against the consumer price index is going to drive inflation. That's why you're seeing the adverse effect in the bond market. The issue is this is going to cause consumption in other areas to go down, as you're about to see here what happened in China. As China's August services activity slows amid the sluggish demand, according to the recent PMI services report. Now, this is the unexpected, because what have we been told over and over? That services is going to lead the manufacturing sector around the world, because during the pandemic, Americans in particular got a bunch of stimulus money, bought a bunch of goods and other things, and now they have money to spend on services. And we've been telling you, the relationship is exactly the opposite. Now, there can be pockets where services does move against manufacturing, but the trend is where manufacturing goes, services follows, and here we're seeing it happen in China. And as I said earlier, this is coming to America, not in the not too distant future. As China's services activity expanded the slowest pace in 8 months. So get this, it's decelerating according to the S&P Global Survey, which we'll look at in a moment, as weak demand. So, I want you to see this from the crude oil report. That's why I wanted to lead with that, because I want you to see that speculators and investors say, oh, look, there's all this demand for crude in China. They're getting out and they're driving around. great. But what it's saying is there's broad-based weak demand in the services sector, and that's what really matters because it continues to dog the world's second largest economy. And to get this, stimulus failed to meaningfully revive consumption. Here we can see the cakes in S&P Global Services PMI dropped to 51.8. Remember, 50 is unchanged. So we see this deceleration from 54.1 in July. This is now the lowest reading since December. The 50-point mark, as we said, that is where the line in the sand is, and we're decelerating here. The data broadly aligned with the official services PMI released last week, which showed the sector continued to trend downwards. Even the record number of passenger railway trips and stellar box office earnings during the summer, get this, failed to drive up the reading. And so what we just saw is some validation here that, hey, the manufacturing PMI went down, and lo and behold, with a lag, no surprise, the services sector is falling despite some bright pockets in the Chinese economy. It's not enough. That's what, of course, everyone on the crude side is missing. But keep in mind, you've got a Russian economy. You've got a Saudi Arabia's economy. They need prices to go higher because they can't afford low prices during these periods of high inflations and high debt. And all it's going to do is cause a further drag on spending, particularly here in the U.S. The slowdown in business activity coincided with a weaker increase in overall new business. Here we go. New orders increased only modestly, not what everyone was looking for, and at a pace, here you see it, well below the average seen for 2023 to date. So it increased, but it's been so subdued, it is below trend. Data suggests this was partially due to weaker foreign demand for Chinese services. How about this? Cost pressures continued to ease in August, with average input costs across China's services sector increasing at the softest pace in 6 months, as higher operating expenses were generally linked to increased raw material, staff, and fuel costs. Now, what we're seeing here in America is still a demand by the services sector for higher wages. This is kind of like the last part you see in the inflation battle is employees say, look, we want higher wages, and the next thing you know, it turns down. We're seeing that now happen in China. They can't even pass along higher wages because demand is getting weaker and weaker. And service providers remain optimistic, expressing confidence in the market outlook. But here we go. Overall optimism was limited as the August reading for their expectations, this is about future activity, usually out around 6 months, recorded the lowest reading since November. So while all these speculators are excited about crude oil, why we're seeing production cuts to drive the price up, what you're seeing in the services sector, which is critical, outright critical, because everybody's been saying we need services to grow. The outlook now turning down at the worst possible time, because as services starts to go down, you can tell it will backfeed and cause manufacturing to further decline. And next thing you know, you start to begin a downward spiral of everything. And China's mortgage relaxation spurs weekend sales in the mega cities. So if we see some of the Beijing stimulus plan worked here, the question we're asking is, will it last? Existing home sales for Beijing and Shanghai doubled over the weekend from the previous one. We were surprised, they said, by the strong pickup in Beijing and Shanghai despite the challenging economy. So here you can see some admittance that the Chinese economy has got some issues. But why do we see a pickup here? Well, if some people were planning on buying a home anyways, or they were marginal, they were on the fence, and this stimulus comes out, sure, they're going to jump on it. The question, again, isn't what the initial effect is. Is this sustainable? My guess, it's not sustainable at all. And as we head over to Germany now, we're going to see more evidence that where manufacturing goes. Now remember, Germany's manufacturing sector, by the data print, is in a depression. And where that goes, well, services, as you're about to see, follows. Here we see from the HCOB, this from the S&P Global, the Germany Services PMI, as service sector activity contracts. There you go. Remember, we saw a slowdown in China. We're seeing a deceleration in the U.S., but here we see contraction in Germany for the first time in 8 months in August as inflationary pressures remain stubbornly high. So this is pretty interesting. Let's take a look at this report. A third straight monthly fall in the headline services PMI saw a drop below the neutral 50 for the first time since December at 47.3, now solidly contracting, down from 52.3 in July. That's a big drop down. The latest reading signaled a solid rate of decline in activity that was the quickest since November of 2022. A survey also showed activity finally succumbed to a sustained decline in demand, and bingo, there you get it. Where's that demand decline coming from? The factory sector. I love it. This is exactly how it works. With inflows of new business across the services sector falling for a second straight month of August. Furthermore, the rate of decline accelerated to the quickest since last November, amid reports of growing reluctance among clients and persistently high inflation. We're also seeing falling workloads and muted business expectations. We note this as they work through backlogs. This is a problem. Placed the brakes on job creation across the services sector on August, saying that now in a matter of months, we should start to see layoffs. Turning to prices, the latest survey data showed sustained strong inflationary pressures across the services sector, driven in part by rising wage demands. So here you're seeing kind of the last hurrah by labor in Germany to get those wage increases. At a time, everything is slowing down. So what will happen? They'll get the increases, and then in a matter of months, you'll watch the layoffs will begin. And it's not just Germany. This slowdown isn't happening just there, not just in China, but entirely across the broad Eurozone as well. As here we see the Eurozone Services PMI business activity fell below the no change mark of 50. So now we're talking about the entire Eurozone area to 47.9 from 50.9 in July. So it was a stall speed in July, and now we're seeing a contraction, indicating the first decline in activity since December of 2022. Moreover, the rate of contraction was the fastest since February of 2021, and all four Eurozone economies posted declines, led by France and, of course, as we just talked about, Germany. And as we expect, the volume of new business fell for the second month running, and the fastest pace for from February of 2021. Adding to that, with new contracts and service providers drying up in August, the level of incomplete, this would be your backlog, business continued to fall. The rate of contraction was the strongest in 2.5 years. This led to greater caution around hiring as employment in the services sector rose at the slowest rate since February 2021. Just as we've mentioned, this would happen. Meanwhile, input prices at service providers rose at the fastest rate in 3 months. So they're seeing services inflation, which I'm saying is probably peaking here, but notably, as they work through those backlogs, and those higher wages get passed through, what you're now going to see is eventually employers will hang on for a little bit, hang on a little bit longer, and then they'll be forced to lay off because they'll have no choice, and we'll continue to see a downward spiral in the manufacturing sector and now the services sector as well, which is something completely unexpected by all the experts, and we've been telling you this was coming. Now, another thing that we think is going to do really well is the stock of our sponsor today. Let's take a look at them. They're Adura Clean Technologies. Again, you can get all the information about them in the description and the pinned comment below. They're a water-based chemical recycling company transforming waste into a 21st century resource. You can find them on the OTC here in the US under the symbol ACTHF and on the CSE under the symbol ACT. They develop chemical technology platforms that transform low-value materials into higher-value resources with the aim of unlocking significant environmental and economic benefit. And one thing we think that's also going to be transformed and unlocked, and that is their stock price. So I've said we're going to show you just how to trade this. At the time of recording, it was trading right around 69 cents. And I want you to see there's these long trending supply zones. We've got this on a 2-year chart. Let's take a look at the RSI. It's at 51 and moving higher. That means momentum is building. We're seeing a positive cross on the MACD coming from oversold territory. That's a positive. A move up here to roughly around 81 cents. There's your 16% move as we go from the buy zone. And I want you to see this. Stock comes down into the buy zone. Buyers show up. It comes down, they show up. Now they're a little more aggressive. They're getting in that supply zone. The sellers are up here. If the sellers are here, that's what you want to do is put a trailing stop up here to capture that gain. If it breaks out, the trailing stop will run with it. Put your stop loss level somewhere down here below to cover your risk. And they're a next generation technology platform, as I've said, turning low value hydrocarbon waste into high value products. They've got a fantastic technology platform that utilizes chemologists as chemical deconstruction of molecules. They've got a strong patent strategy and multiple market applications for upcycling plastic waste, upgrading heavy crudes, and upgrading renewable oils. And this is a new approach in chemical recycling, as Chemolysis is the fourth new generation chemical recycling approach to convert the diverse feedstock, and Aduro is the leader. They are the one, again, on the OTC under symbol ACTHF or the CSE under ACT. Let's zoom in and check out the 90-day chart here. What do we see? Beautiful amount of buying here. Momentum on the RSI is going up. What do we see on the MACD? Positive cross. This is all a positive sign. You'll notice how it moves between these supply zones real quick. So this could be a nice 16% move. Keep an eye out on that. And perhaps if you see it a good move for you, take a chance. And let's take a look at the capital structure here. They've got about 63 million shares outstanding. And what we can note, that is got 43% of insider ownership. And we vet these companies out. They are not looking to sell. They want to see their stock go up. They want to see it break out to the upside. And why invest in Aduro? Well, they've got a unique patented next generation technology platform that nobody else has. They've got strong international partnership, and they are working with industry leaders here. They think their stock price can go a whole lot higher, and we think in the short term it can definitely make a very quick move. As you see, when you move between supply zones, you see it move down, find support, buyer step in, next move is all the way up. That's where the sellers have been. We think that could be a very nice 16% move for you. But as always, with any sponsor we show on here, you're under no obligation to buy your stock. Do your research before placing any trades. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.